When it comes to incorporation, there's different options. Some will incorporate on their own, typically, not do everything correctly. They might use like a legal Zoom service, or they'll use an attorney. I would say the biggest probably mistake they make is they don't really take into consideration the taxation situation. Maybe they read online about the type of entity they want to have, or maybe they talk to an attorney about what they recommend, but they don't always, unless they come to us first, they don't really address the taxation issues, and that's where it can get them into trouble, or at least be less favorable for them in the short term. It's more of a long-term consequence typically. We have a lot of clients that might initially form an entity outside of their state that they live in and operate their business from, because they think they can get out of state taxes, and then they realize, okay, well, I actually need to form a foreign entity in my home state, and then they still have to pay all the fees associated with that. So a lot of times they wind up paying more money because they thought they were going to save money by trying to be sneaky and registering the business out of the state, when they find out, in order to be compliant, they actually have to register in their own state because they have nexus in that state, right? That's one issue we run into a lot of times. We have a new client who's a window cleaner. His accountant, who's, I guess, no longer around, advised him that he should set up a Nevada corporation. He lives in California, his business is in California, and the idea was to do that, he would save the $800 a year charged by the Franchise Tax Board. So the Franchise Tax Board in California charges an $800 minimum fee, and not everybody's happy to pay that. So the thought was, okay, well, you just register in Nevada, to California, and you'll save the $800. For the last 8 years, yes, that's been the case, but the problem is, the state doesn't go by that rule. So it's just kind of a ticking time bomb. When the state catches up with him, they're going to hit him with the $800 a year because he was basically operating in California, but he wasn't registered right. So they're still going to want their money. 90% chance maybe he'll get caught, and maybe he won't, but they're trying to crack down on that more and more. So there's potential risk there. The other risk that he has is, since he's not registered as a foreign corporation in California, he doesn't have any legal protection here. So if somebody falls off a building, right, and sues him, he doesn't have any corporate liability protection because he's not registered in California. Totally unaware of that, right? So people try to do things on the cheap, or they try to kind of black hat of accounting, right? If there's any problems, they'll catch up with them eventually. So a lot of this stuff doesn't happen right away, or let's say there's a lawsuit, right? So you might be operating for 20 years and never think there's a problem, but once you get a lawsuit, that's when all these things kind of come to the surface, or if someone gets audited, right? Again, maybe 5 years is fine, nothing's happened, but all of a sudden they get audited, and then they get reamed. So that's the potential risk there.